Us, we are live. We are live. We have 9:49 yield bill on for a possible vote. I'm gonna give us a chance to look at it.
We just got it.
Yeah,
I don't even think I would.
that's Julia and John. And if possible, think about it, could we move out 710? That's that utility road bill, road and transmission wire that we took testimony on Friday. No one has come up in opposition other than Smith, and turns out the place she was concerned about
It's not an issue.
is not, yeah, it's not covered by this bill, that particular project. Okay, so we're gonna move on. We're going back to Friday.
On 710, at some point, I thought I heard you say you might want to send it to natural resources. Is that how you're thinking?
I've talked to Natural Resources,
Sorry.
if we send anything, they would like,
Utility bill?
and I would like to send them the data mining, because a lot of that is impact on natural resources. So that's the other one. I've been watching 710. It really is utility regulation. I've talked to Senator Watson. I alerted her to the problem on Friday, but
Road.
yeah, this is the road, the transmission line.
Makes sense, coal mining, iron mining, data mining, same thing.
Oh, okay, mining,
Oh, are you wanting to vote that today?
possible.
Okay.
The yield bill.
Okay,
Not-
Ready for a motion?
No, we're gonna get testimony before we have a motion. And right now, we're going back to last Friday, 9:33, which is the miscellaneous tax bill, which is the one we have to get out of here. We have been told to get out of here this week. And we ran out of time. So Pat has some slides to help us understand the denser say of this bill. Some of it's pretty straightforward, and then there's a lot of coupling and decoupling with federal law and recoupling in other places. And that we're going to go, this needs to go with the budget, because there is revenue in this bill that is spent in the budget. So they need to know that the revenue's coming or the budget is in trouble. So let's start. And I believe this is really, it's in the and decoupling that we're going to pick up. So,
Yeah, so Patrick Turton, Joint Fiscal Office. Guess we're gonna go through a couple of things. First is going to be something we saw all the way back in January. It's just a little explainer of how federal tax changes show up or don't show up on your Vermont state tax returns. We're also going to give a little context about why the House took some of the steps that they did to mitigate some of the revenue that would be lost under normal conformity. And then we'll go through each piece that is flowing through and what the expected impact for Vermont is. And then at the end, there's time we can just chat a little bit about what you were just talking about as it relates to the budget and that whole construct between the two bills. Yeah, so just starting off, personal income tax code, we rely on form 1040, which is an IRS form. This is basically just the math that you do every year to get up to what your total income is.
Chris has been doing it rather recently.
Happy tax day tomorrow for all of themselves, right? So yeah, you can see on here, it's going to include everything from your W-2 income, such salary, wages. It'll include your tips, dividends, capital gains. This is really just sort of a starting point, building up to what's referred to as adjusted gross income. So if we're looking at the form here, you can see that everything from 1 through 10 feeds into this line 11A here, which is the starting point for Vermont income tax code. So when you hear a phrase like something is above or below the line, it quite literally is a line on the form. So if the feds were to make any changes affecting lines 1 through 10 here, that would be something considered above the line, which is something that would flow through to your Vermont tax return because our starting point is right there on that line. So these are all the provisions on the form that are considered below the line, stuff that happens after the calculation of AGI. Some of the provisions that were in HR1, that you might have heard of the no tax tips, the overtime, the expanded deduction for senior citizens. Those are all things that are showing up here in that line 13B. So those are all below the line, past the point where Vermont starts its return. So we're just pulling that line 11A, and we're not considering anything that's below here. So you'll see that a lot of the personal income tax provisions, things that you are filling out on your own forms, are really not being affected on the state level in Vermont, because a lot of those things are happening below the line that do not flow through. And again, I know you've seen this graphic before, but we start from that federal adjusted gross income. That's at line 11A. We do add a couple of things in Vermont, accounting for bonus depreciation and interest from non-Vermont state and local bonds. Those get added back. But then there are alterations to that amount, which get us, including the standard deduction, personal exemptions, other exemptions that Vermont allows, which gets us to the taxable income amount. That taxable income amount is what we then flow through the income tax brackets with. Those are marginal rates. So it's a graduated bracket. The more, and it's own, when I say marginal, if you look at that top rate of 8.75 on the single filer schedule there, that 8.75% is only being applied on the income over that amount. So that's where the marginal effect of the brackets come in. So after you feed through the brackets, you get your initial liability, but there are still more adjustments that Vermont does do for personal income taxes. These include non-refundable credits and refundable credits. I just have a little highlight here because there's one personal income tax provision in HR1 that is technically below the line, but because Vermont has its own state level credit that is 1% of the federal credit, even though it's below the line because we're basing it off them, that change flows through. So there's some exceptions, which is always great to the above the line, below the line discussion, but what you'll see later on, but that is in the flow, the workflow, that's where that shows up. So we go through all the subtractions and the rate schedule and the credits, and eventually that is where you end up with your net, your final Vermont tax liability. So that's just sort of the flow of personal income taxes. Second thing I want to talk about is the flow of corporate income taxes. Again, we have a form here. The IRS form is 1120. There's two components to that form. The first one is adding up everything that goes into what is considered income for a corporation. So there's the gross receipts of sales, the gross profit, dividends, what have you. So all of these are building up to what total income for the corporation is. But you can see here that again, our starting point is further down the form. So we're pulling from line 28, and that is within the section of this form that includes a lot of deductions. These include for deductions for things like rents, taxes, charitable contributions. So in this instance, this is why you'll see a lot of the HR1 provisions that relate to corporations and businesses. A lot of those are flowing through, and a lot of what you'll see, of what you do see in the bill, is reacting to what would flow through the change in revenue as a result of the policies in HR1. No corporate income tax discussion is ever complete without me doing it. Just a quick reminder on single sales factor. So Vermont uses the U.S. definition of taxable income for unitary groups within the U.S. Unitary group is going to include the parent company, all of its controlled subsidiaries. One thing that the US government doesn't have to account for is that they don't have to think about apportionment for business activity that's happening nationally, right? It's the federal government. But when you get to the state level, every state will have a mechanism that accounts for the fact that, well, you are making money all over the country. We're going to focus on the money that you are making by selling each of the state market. So that's where the single sales factor apportionment comes in. From the form we were looking at earlier, that federal taxable income line, I think it was 28, is our starting point. That's this bottom left quadrant here. And then what happens with that is we multiply that by the sales factor, and really that's a relatively simple calculation of if you take your total sales for the unitary group, this is sales, not profit. Take those total sales, and that becomes your denominator. And then you take all of those sales that your unitary group made, that they made into the state of Vermont, that becomes your denominator. So by just dividing one by the other, you get sort of a ratio or apportionment factor, which says, okay, this portion of your total corporate profits, we're considering that taxable income in the state of Vermont. So again, here are the marginal tax rates for this. Top marginal rate starts at $25,000 of income allocable to Vermont at 8.5%. There is the minimum tax. Those brackets you see there and the corresponding minimum tax owed relate to gross receipts, not gross receipts into the state, not taxable income. So that's a really quick run through, and I am trying to go a little fast because I know some of the time constraints, but definitely jump in with anything you need clarification on. The next thing I want to talk about is why are you seeing a lot of these provisions in this bill? How do we get to the point in what was sort of guiding the House's decision to make some of these proposals in the context of how it fits within the budget? So if you remember back in January, we had identified a list of things that flowed through to Vermont because they're considered above the line. And these are all, each one of these bullets are something we're going to go through in detail. But quickly, there's a deduction for domestic research and development expenses, limitation on business interest deduction, expensing of depreciable business assets, special depreciation allowance for qualified production property. There's foreign income changes. There are changes to pro rata share rules, charitable deductions for corporations, qualified changes to gains from qualified small business stock, and frankly, quite a few other sort of miscellaneous small pieces that change at the federal level and would be expected to flow through. And then the one personal income piece that doesn't relate to businesses or corporations is that child independent care credit, which the federal government and HR 1 did opt to expand. So that's something that you see flows through here.
What's PIT stand for?
Personal income.
Personal income.
Okay. So you back in January saw a very different version of this table. When we looked at this in the first week of January, I think that you probably would have looked at it and said, well, this doesn't really move the needle up or down one way or the other. And that was really our sort of first preliminary look at all these provisions, which frankly, there's kind of a bit of a dearth of the information out there for us to do our work on this. It was still very early in the process in terms of revenue reporting, both from other states and reports that the federal government does release. So one thing that really jumps out, and one thing that ended up becoming a much bigger deal that we'll spend some time talking about, was that second line there, the full expensing for domestic R&E. We saw from, again, federal receipts reports that were coming through. We saw from other states how their corporate income collections were going, and noticed that this was definitely looking like a bigger deal than we had initially thought. So using some of that updated information, we did end up landing a much larger number. And I think Chris may have mentioned this on Friday, but worked very closely with the tax department. These are considered consensus estimates for this. And so,
Sorry, what does R&D stand for?
oh, sorry, that's the research and experimental procedures expense deduction.
Okay, so kind of R&D, but okay.
Yeah, so R&D, a lot of people, people usually call it R&D. It's largely a very similar thing, but this is the deduction that's available for businesses as opposed to the credit, which for my state level. So why does this matter? Fiscal year 26 is the one we are currently in, and when these numbers were updated, you had all already passed the BAA, which is meant to true up. So this negative $21 million that you see there was not accounted for in the budget. You know, and again, this table is showing you if we assume regular, normal conformity, just linked up to everything. So, yeah, so and these figures were not accounted for in the consensus forecast, right? Because what the economists were working with at the time showed a more muted response to revenue. And also the forecast is generated based on current law. And the decision whether to link up or decouple is an active decision that the legislature makes.
Patrick, what was your initial estimate for 26?
Oh,
Do you remember?
I don't remember exactly, but it was in the low singles of millions.
I thought something like 2.5
Oh, wow.
That sounds right, something in that neighborhood, but yeah.
decimal.
But I've heard it referred to that, yeah.
21 is not decimal.
No.
Yeah, and that's you know, that's the fiscal year we're currently in. And you know, even looking ahead to fiscal year 27, that's the year that is the budget is currently being built for. And again, assuming full conformity, that $33 million would need to be accounted for when building that budget.
Now you see why they want this bill up before budget.
I think that's the full context of sort of why your colleagues in Ways and Means knew that or made the decision to make some of these choices. You know, I think a lot of it really did come down to the budget conversation and how, you know, Vermont has a balanced budget and it always has. So
Trust me, we've been here until midnight for $1 million, never mind 33 million, so.
Maybe you're getting to it, Patrick, but what will this do to those numbers? Are we gonna talk about that at some point?
oh yeah, I'm gonna go through every single item, don't worry. And that's why I was being a little concerned with Charlotte about how much time we have, but
We'll make them.
but no, we're gonna go through everything.
It's just children, John.
Yeah. All right, so proposed language. There are several instances where your colleagues in the House decided that they were comfortable with linking Vermont up to the federal changes. This included, and I'm going to explain what all these things are, that it included the expansion of the child and Medicare credit, the amended limitation on business interest deduction, the expensing of depreciable assets, prorated share rules, charitable deductions, the deduction for research and experimental expenses for small businesses. So that's one area where they're deciding to link it up. But on the other hand, there is language in there that decouples from federal treatment on this for larger businesses. And again, I'll explain what that change is. There's also some language relating to the bonus depreciation for production property, qualified small business stock, and then section 250 deductions, which are those international provisions that I mentioned earlier. So those two buckets there are the areas where this bill is directly reacting to HR1. You can see that there are additionally 3 other areas of tax that the House sent over to you that change. There is the increase in the cap of the downtown village tax credit, which I know you've taken testimony already on this biennial. There is a increase in the state research and development credit. So it's different than the deduction that was being altered at the federal level. That's increasing that deduction, or sorry, that credit from 27% of the federal credit to 75% of the federal credit. And then lastly, another thing I believe you've taken testimony on this year was that down payment assistance program through VHFA. You know, the ability to sell tax credits was set to run out at the end of this year. What this does is reauthorizes that ability for VHFA to sell those credits.
Yeah,
but
we
if you-
also looked at the downtown village tax credit.
Yep.
So this is $500,000 what it was.
Yeah, came to your committee from the Economic Development Committee at $1 million. You all, as you remember, passed along the SAC at 500,000 expansion. Okay, so we're going to talk about all those things. Federal changes to the child dependent care credit. So HR1 expanded the phase down of the federal CDCC and increased the maximum reimbursement to 50% from 35%. And I have a chart either on the next slide or the slide after that shows you what the change in that phase down really means. So basically, it is income dependent, you'll see. But basically, when I say reimbursement rate, if you're of the, I guess, appropriate income level to qualify for this, for every dollar you spend on these eligible care expenses, you'd be able to get 50% of the back. So we do have a state level CDCC, and it's just set equal to 72% of the federal amount. It is refundable. And because we just piggyback off the federal definition of this credit, that's why even though it's below the line, it does go through to the law when they make a change. Another example of a credit where that would happen if they changed it federally, and actually has happened in the past when they changed it federally, is the EITC, the Earned Income Tax Credit.
But that's only for at age 6, right, for the state?
That the child tax credit is a different one. This is child dependent care credit. So this is specific to expenses you have for, you know, daycare, things like that.
Okay.
So yeah, we have this on the books already. The last tax expenditure report estimated cost at $4.8 billion in foregone revenue for fiscal year 26. That's the previous law. So any changes you'll see in any tables in this presentation will be additive to that amount. And yeah, so the language in the bill would conform Vermont to those changes done at the federal level. And this is just an illustration of how that phase down change of what it looks like. You see the changes that were done as part of TCJA, they're in green. And then there's two colors, blue and orange. Orange refers to unmarried taxpayers. The blue refers to married. Previously, there was no distinction on filing status. So that's one change done federally that, it's coming through here. And you can see what these lines refer to are the reimbursement rates. So the percentage of your expenses that you can get back through this credit. So you can see at the really low income level, up to about 15,000, and you're going from 35% to 50% reimbursement rate. And then it just phases down over time. So at all this white space between the blue line, the orange line, and the green line, those are expanded reimbursement rates. Okay. Second thing, there was an amended limitation on business interest deduction that was part of HR1. So HR1 expanded that limit to which corporations can deduct interest paid on loans for business purposes. And so the limit on business interest deduction is limited by the sum of their business interest income. So that's one limitation. The floor plan financing interest, and this is something that I learned for the first time I'm going through this, That refers to, mostly it applies to car dealerships. They get the vehicles from the manufacturer on credit, and while it's on the lot there, they owe interest until they sell it and recoup it. So that's one limitation for that type of business on how much they can deduct. Or the third limitation is 30% of their adjusted taxable income. So what HR one did was it expanded the amount of business interest paid that can be deducted from 30 to 50%. So you can deduct half now of the interest you're paying on loans for business purposes. This is an area where the Ways and Means Committee made this decision in the language to conform with federal treatment. One reason for that decision was that the Department of Taxes actually came in to give their thoughts on the conversation of linking up and decoupling. And this is one provision that they had identified as would be really difficult to administer if the state were to decouple from federal treatment. That's business interest. The next provision had to do with the limitation on expensing for depreciable business assets. This is a provision that's really geared mostly towards small businesses. So what HR1 does is it increases the maximum amount that a taxpayer may expense for the cost of a qualifying depreciable business asset in lieu of recovering that cost through depreciation. So basically being able to take that expense upfront for those investments that you may make in a depreciable asset rather than spreading that cost over an amortization schedule. So what the bill did was it increased that limit for the amount that could be expensed from 1 to 2.5 million. And that is one of those provisions that's going to be indexed for inflation annually. This was another area where the tax department came in and said that if we were to decouple in this area, it would be a very challenging administrative task for them to implement. So yeah, they decided, or the Ways and Means Committee decided to pass out language that conforms in this area. So that's what you have received. Pro rata share rules. HR1 changes the treatment of controlled foreign corporation income. So just briefly what that is, a foreign corporation is a CFC if at least 50% of its voting power or value of stock is held by US shareholders. So each US shareholder must include in their gross income, so when they're filing out their tax return, their pro rata share of the CFC passive income in that tax year. So basically, I own 20% of this controlled foreign corporation. I have to include 20% of that passive income on my return when filing my taxes. So it basically functionally what this does is it is going to require people who have ownership in this type of with ownership in CFCs with this type of income to report more of their gross income. So it would be a revenue increase in that sense. Again, so this language is conforming to that change. HR1 made a change to the charitable deductions for corporations. Previously, corporations could deduct charitable contributions limited by being up to 10% of their taxable income. So you could not take a deduction for these contributions in excess of that amount. And what HR1 does is, I've tried to think of a few ways to explain this. I think the best one for me anyway is HR1 instituted a bit of a floor. So charitable contributions between 1 and 10% can be deducted, but that bottom 1% there, which, you know, when they're from 0 to 10%, you could take, it's just slicing off that bottom piece of it. So really it's 9%, but with a floor.
Okay.
So yeah, this change reduces the amount that can be claimed by 1%. You know, the language that you've received from the House is conforming with that change. Okay, So the deduction for domestic research and experimental expenses. This is one of the provisions that received probably the most attention because it is pretty complex. And the solution is not as simple as simply linking up, which is not. And again, going back to that slide I showed you, assuming full conformity with everything. This is really the piece that when we updated the estimates with the tax department, this was a really big cost driver, contributing to that $21.3 million revenue reduction we were estimating for fiscal year 26. Okay, so HR1 changes how corporations calculate their R&E expenses, the deduction amount for that. So starting in 2022, Tax Cut and Jobs Act had said these expenses were required to be amortized over a 5-year schedule. So that just meaning that the benefit from the deduction could only be realized in an incremental schedule. Prior to Tax Cut and Jobs Act, the treatment was you could take the full amount of the deduction for those expenses in the year that they were incurred. What HR1 is doing is it's going back to pre-Tax Cut and Jobs Act treatment for this. But so functionally, what it's also doing is it's allowing you to fully expense upfront in the year that it's incurred, but it's also allowing any expenses that you had incurred between 2022 and 2025 to retroactively claim those expenses for the deduction. So what it really was doing is it was front loading of, when you look at it in context of revenue to the state, it was really front loading a lot of the cost of this deduction, which is really why you see those very large spikes in fiscal year 26 and 27. If you were to look at it in the super long-term horizon, eventually after all the amortization smooths out, it'd probably be more about revenue neutral, but we have a lot of those front-loaded costs that affect us in the very near term if you were to fully conform. So what did the House do? So the House decided to say, well, if you're a small business, and that's defined as having, let's start with that. A small business is defined as defined federally as business with average annual gross receipts over the preceding 3 years of 31 million or less. And so what the language is doing is saying if you are if you can be defined as a small business like this, we will allow you to basically follow the HR1 treatment, which is to fully link up with their provision of being able to fully expense those or fully deduct those expenses in the year that they're incurred. For non-small businesses, all those with the average gross receipt over 31 million, what this language is in effect doing is saying that you need to maintain your Tax Cut and Jobs Act treatment of amortizing those costs over a 5-year period.
Is that in perpetuity or is that just for this 5-year period from 2022 to 2027?
That is in perpetuity. So it's going as, that's how, so Kirby wrote out the whole section for statute, basically describing how these expenses would need to be amortized over a 5-year schedule going forward. So 2 things here. One is conforming language for small businesses so they can fully deduct those expenses in the year that they're incurred. And the other is for the non-small businesses, telling them that they have to maintain basically the Tax Cut and Jobs 5-year amortization schedule. So for those large corporations, or defined as non-small business, it's essentially a revenue neutral because they're just continuing their existing practice. For those corporations or businesses that can be defined as small, that would be a revenue decrease. Okay, so the special depreciation allowance for qualified production property, essentially what this is bonus depreciation. So for these, for eligible non-residential properties that are, for production, I forget what any change, so the changes that, here applies to the properties built for bond after January 19th of 2025, but before January 1st of 2029. So for any buildings bought in that time window for production property, you can fully deduct you can take the bonus depreciation. So basically taking all the depreciation up front rather than what you would do before is take that depreciation over 39-year schedule. Vermont does this in other areas. So if you remember when I was talking about the flow through, when we we're looking at the personal income tax slides, Vermont adds back bonus depreciation, other types of bonus depreciation, and does allow, but at the same time allows regular depreciation. So this is basically in keeping with how Vermont treats other types of bonus depreciation. And it actually is something the tax department came into the Ways and Means Committee and asked for that to decouple from. So what the language is doing is it's not allowing all of that depreciation to be claimed up front, but it is allowing them to still depreciate those assets over a 39-year period. And yeah, so the language is decoupling Vermont from the federal treatment in that way.
What is a qualified production property versus a non-qualified production property?
Some of the provisions I think were specific to production of agriculture, refining, and there was one other one, chemical. Thank you.
Those are qualified.
Production. Those are, yeah. So if they're engaged in those kinds of production, that's what would qualify. So you can think things like fertilizer, things like that. Those would be considered an eligible or qualified production property for this specific bonus depreciation provision.
And non-qualified is everything else. Manufacturing facilities for anything besides chemical, agriculture.
Well, there are some other types of bonus depreciation. So I don't want to say no other types of properties wouldn't qualify, but this is specific to those types of properties. So yes, a lot of other types of properties are still going to have to be or depreciated on that 39-year schedule. Okay. So the exclusion on gains from qualified small business stock. HR 1 allows stock for corporations issued after July 5th of 2025. And specifically, this is for corporations with aggregate gross assets below $75 million to qualify as a qualified small business stock. What HR 1 did was increase that cutoff to be considered to be eligible as a qualified small business stock from 50 million to 75 million in aggregate gross assets. So making larger the type of business that would qualify for this. But also it did make some changes to the schedule for which if you are an owner of this stock and you sell the stock, you can basically claim those capital gains tax-free. They're not subject to taxation. So previously, if you held on to this stock for 5 years, you could fully exclude those gains from that sale of stock. What HR 1 does is that after 3 years of holding it, you can get 50% off, 4 years, 75% off, and then again, 5 years, you can fully exclude the gains from the sale of that stock. And then, yeah, so the per issuer exclusion cap from 10 to 50 million, this has to do with how many one person could buy from a corporation. You can invest in multiple qualified small business stocks, but from any one particular one, it's limited by that amount.
Can I ask about this? So
Sure.
this language would decouple Vermont from federal treatment of this class stock, but would allow the Vermont capital gains exclusion to apply. So decoupling it means that the per issue exclusion would not apply to Vermont, correct? And
So
the cap moving from 10 to 15 million.
So the cap moving from 10 to 50 million and then the 50 to 75 million, that's really more so a function of how much can you have in assets to qualify as this type of business to issue this type of stock. And then how much each issuer can purchase. Where we really start to sort of think about what the impact of the state is whether the gains from that stock it's tax eligible. So that's kind of where the revenue rub comes into play on that.
Okay, so decoupling it means that the gains from this federal tax change are not flowing through to.
Yeah, so I guess I should take a step back too on that piece. So in this instance, rather than freezing in time that previous treatment, the language decoupling for Vermont is disallowing the ability to exclude the capital gains from these types of stocks from your income tax calculation. So we're saying rather than the 3, 4, 5 year percentages of that you can exclude, Vermont is saying you have to include all your capital gains from sales of new stock in your AGI calculation.
Okay.
Yeah.
But would allow the Vermont capital gains exclusion to apply. So you include it in your AGI, but then
you can some of that amount, depending on how much you have, can be put towards the capital gains exclusion.
Okay.
And I do know that Kirby is going to want to talk to you about some language for that. I think tomorrow or Thursday.
Yeah, Kirby Key Legislative Council, there was a House floor amendment to clarify surrounding the Vermont's partial exclusion, the 40% exclusion. And after reviewing it again, what I drafted didn't go far enough. There's still ambiguity there. So it's something that I think that we should clean up. So we'll talk further about how Vermont's exclusion applies. The short version is Vermont's 40% exclusion is not allowable for stock gains. So I removed the language expressly preventing it, but I did not account for what's in current law about stock.
okay.
So as it's written, it's ambiguous, but it seems like the 5,000, because there's two exclusions for Vermont. You have to choose one, either the first 5,000 or you could use the 40%. The first 5,000 could be used for these gains under the language you have. The 40% gain, probably not, because it's stock.
Okay.
The House did intend to allow that 40% exclusion.
Okay.
Okay. So, section 250 deductions. HR 1 amended the IRS, the Internal Revenue Code, section 250, to adjust the amount of foreign derived deduction eligible income. I've heard it referred to as today. Domestic corporations can deduct from 33.34% of net CFC tested income. And they also changed the income, the deduction amount for today to 33.34%. And then they also changed the deduction amount for net controlled foreign corporation tested income, NECTI, to 40%. So really what's going on here is a couple of different things. HR 1 is expanding the base of this foreign income by removing some, by simplifying the math, I guess is really a simple way of saying it. So they're expanding the base of the income amount. They're also reducing the amount that can be deducted for corporations, but at the same time to offset some of those increases, right? Because expanding the base and reducing the deduction would cause tax liability to go up. The federal government also expanded the credit corporations can receive for taxes paid to foreign countries. So, previously, this type of income had been, referred to as GILTI, global low tax income, global intangible low tax income. And it's that intangible piece that was kind of the impetus for a lot of it. So, at the time, the narrative was, well, these big corporations are setting up a subsidiary in, I don't know, Ireland, parking all their intellectual property there, and then the parent company is paying royalties over there. If you look at how the math of the equation actually goes out, it's really just foreign business activity. I think with these changes that they made in HR1, they were kind of admitting that, you know, this was never really actually targeted at intangible income, so things from like property or you know, intellectual rights, intellectual property. So that's the piece where they are sort of expanding the base, right? And so with those different moving pieces, so expanding the base, reducing the deduction, expanding the foreign tax credit, that was sort of the HR1 response to sort of how they were administering foreign income for corporations. Now, when you look at this on the state level, again, the federal government does not have to worry about apportionment. So what they do to account for taxes paid elsewhere is they provide those credits for taxes paid to foreign corporations. Those credits do not flow through to Vermont. So basically, that's why you have state, again, this kind of comes back to the discussion of why states have apportionment. So why we have a single sales factor. We can't do for corporations anyway, credits for, you know, taxes paid to other states or countries. And also, you know, when thinking about international taxes, are they taxes at the national level internationally, or, you know, an international equivalent of a state level? So that's why we rely on the single sales factor for looking at this. And so what the language is doing is it's accepting the expanded base. It's acknowledging that we don't have.
Can I stop you for just a
Yes.
second? I'm sorry, Vincent.
Of course.
What section of the bill is this in? Do you?
Is it 63?
It's in section 55, but there's all of the decoupling languages in 55. This would be the decoupling language, the subdivision that refers to 26 USC 250.
Yeah.
Okay. All right, sorry, Pat.
Oh, it's fine. So what the language is doing is it's removing the ability to deduct any of this income, because really what those deductions are doing is saying this type of income is receiving preferential treatment at the federal level. And you know, not treating it like regular business income. So then what the language or what the intent is, rather than relying on credits like the federal government's able to do, rather than relying on deductions, like it's in federal law, let's just have the single sales factor do the apportionment for us on this. And okay, so how does that work? So in a sense, by removing the deductions, if you remember that equation I had earlier, you're increasing the federally defined net income calculation. But because we're requiring you to include that income, we're also going to be providing what's called factor relief, which is the income or the sales that are associated with that income can be counted in the denominator for the apportionment factor. I can hop back to that equation if that would be helpful.
Let's keep going.
Okay.
I think it's gonna take a while to
Yeah.
digest all of this, so we get through it once.
Patrick, report this on the floor.
No, we can't just slides in.
Sit over in the corner and nod his head.
Yeah, sure. I'm good at that. Okay.
Feeling, I usually report this and Patrick will be sitting on the windowsill behind me.
Well, you can have Kirby.
Both of you.
So
No, just you.
we have gone through all of the most complicated sections. So when we're done talking about link up, we're done talking about decoupling. The next couple slides are just other areas of tax code that this bill is adjusting.
A little less dense.
Yes, I hope so. So the first piece is the research and development credit. I know we talked about this a little bit last Friday. So currently what Vermont has on the state level is a research and development credit, which is equal to 27% of the federal credit. So that we're basically piggybacking on this federally defined calculation for what the amount is. But we're going a little bit further and saying that it's only for research and development, or this is existing, right? The only expenses that are eligible are those that are done within the state of Vermont. So it's an R&D credit for R&D activity within the state of Vermont. And I did send Charlotte the tax department's report of all the Vermont businesses that do claim this credit. So I think you should all have that. There are a lot of familiar names on there. So what the I guess just a quick little explanation of how this credit works. Basically, to claim it year after year, you're going to have to show that you have increasing R&D investment over time, because the way it's calculated is you take the base amount, which is defined as the average R&D spending in the previous 4 years per year amount. What is the difference between what you spent on R&D this year compared to that base amount, which is that average? So to continuously claim it, you need to be investing more money over time to get that incremental amount that you can claim. And so it is a non-refundable credit. So if you don't have the liability to offset, if there's a 10-year carry forward for the credit. And so what the language is doing here is it's saying, okay, instead of 27% of the federal amount for, those Vermont specific R&D costs, we're saying based on what you can get federally, you can actually have 75% of that. So it's going from 27 to 75% of the credit that you calculate based on federal rules for those Vermont investments. So I think last week, the 27 to 75% seemed like a huge jump when you look at how it sort of plays out, both in sort of the tax liability and what corporations can offset. And when you think about the fact that it's really only the incremental amount, the dollar figure attached to it is not as stark as you might think with that significant change in the percent. So I did leave off slides explaining the down payment assistance and the downtown village tax credit, because I know you've taken testimony on those and probably don't need the reminder again.
I think they are annual events.
Yeah. So this is the table summarizing the net impact of all these different changes that we kind of just raced through a little bit, but hopefully there's a lot of good information in there. You can see that again, we still are including a fiscal year 26 revenue impact because, a lot of the conforming changes are retroactive to tax year 25, to get money in fiscal year 26. So it's the year that we're living. So I guess I'll pause here for a sec. One note that I think I failed to mention on the research and development credit increase is that the effective date for that is starting in tax year 27. So it wouldn't affect fiscal year 27, it would affect fiscal year 28. But compared to that full conformity table we saw earlier, instead of a $21 million decrease in fiscal year 26, we have a $3.96 million revenue decrease. Instead of I think it was a $33 million revenue decrease or downgrade for fiscal year 27, you're actually showing a net positive of 14.25 million with all of these different tax provisions put together. And I know Chris may want to talk about this a little bit more, but this revenue you see here is built into that construct of the rooms transfer and the purchase and use transfer, and those different changes that are essentially trying to get a little more money into the fee fund while keeping the ed fund whole. And what this is trying to accomplish is, with that transfer of meals and rooms into the ed fund, keeping the general fund whole as well. And I guess the last thing I'll just throw in on this slide is that when thinking about the budget for this year, really then what you would want to do is combine that 26 and 27 number. So it's really more like a $10 million revenue increase when considering, this year's budget. But again, Chris can talk a little bit about that construct if you want a refresher on that. And this last slide here, this is just from the fiscal note. So you saw this on Friday. It's on the very first page, and it just summarizes all those different moving pieces together, and how the different provisions are coming from one fund and going to the other, and how the revenue provisions in this bill sort of build up to that.
That's the question.
Yes.
Okay. Patrick, so up 13 million-ish in FY 27, up 14. There you go. What type of corporation is going to look at this and it's going to, gonna hurt their bottom line? What big multinationals? In Vermont, out of Vermont? I mean, I know we can't name specific companies, but.
Well, I don't know. The tech department might know specifically.
Yeah, right.
But yeah, so I mean, I think it's going to be the larger corporations, with two things here. The international income, that's going to definitely typically skew more towards large multinational corporations, right?
Okay.
And then the other one is the requiring those businesses not defined as small business to continue amortizing their research and development expenses.
Okay.
However, a note on that is that is sort of continuing their current experience, right? Requiring them to continue amortizing, that's what they're doing today already. They might have to spend a little more time on their return doing that calculation. But those are probably two pieces that I think would relate to larger businesses.
What about the out of state, in state? Or how does is that, or in state like the global foundries or something, if they don't have any income, corporate income tax liability in the state of Vermont, does this even impact them at all?
Likely not. If they're not, I mean, really, it all depends on how much they're selling in the state, right?
Yeah.
If they don't use Vermont as a customer base, they might have a factory here, and sell exclusively out of state and have no liability for any of these deductions to apply to the state of Vermont. They might still file a return here because a lot of corporations do file zero returns in the state, just to be consistent and have all their ducks in a row.
Okay, thank you.
Do any of these provisions or anything else you've seen have any particular negative impact on Vermont?
I would say, I kind of go back when I get questions like that, I kind of go back to, thinking about the single sales factor and how that operates. The Vermont corporate income tax code with that single sales factor is saying, we really don't care where you're based out of, but if you want access to the market in Vermont, then, the portion of your income that's coming from that, we think you should be, reporting to us as taxable income. So, I mean.
So the company that has great sales someplace else, internationally or otherwise,
I'm sorry, could you repeat that?
could a company that has very, very large sales elsewhere, either in the United States or outside the United States, find that Vermont is a particularly unfriendly place to do business because of the way our tax code is structured compared to other states?
Well, I would say, in the realm of, I mean, I don't necessarily think that any of these provisions are going to affect a business's decision whether to be based here or not, to have a physical presence. Because again, if they're not selling into the Vermont market, they're not going to have liability here. But, at the same time, if, it's not a phenomenon we've seen where a corporation has decided, Vermont's got these rules, we're just not gonna sell to Vermonters. We haven't seen anything like that. Apple still sells its iPhones,
Well, it's the ability to
Or still
recover
got-
expenses that I'm most concerned about, where the sales are not great.
well, if it's still not great, they're not gonna have the liability.
And a business is operating here and incurring expenses. It's not necessarily adverse to them in general. Is that a fair statement? Our tax code?
I guess I'd respond with that. I don't think so, if I'm understanding the question correctly. You could have your business based in Brattleboro, you could have it based in Lowell, Massachusetts, right? And how Vermont's tax code is structured is gonna affect you just the same if, sales are the same in the location. So,
Yeah, you used to, if you had a plant here,
Mhm.
you used to get more heavily taxed.
Yeah.
And that's one of the reasons we changed it,
Right.
because arguably you were getting taxed for providing jobs and other
Yeah.
benefits to Vermont.
So that was a clear instance where, by not dinging you for having a physical footprint in the state,
That's essentially what I'm getting at.
Yeah.
There's nothing that you see here that gets us back into that situation again where something adverse is happening.
No, I don't think so. And there's a provision in here, the research and development credit increase. That is again specific to expenses incurred in the state of Vermont. So if you're a Vermont-based company and again, if you look at the list, a lot of the businesses on there are breweries,
Mhm.
right? So by being based here and having that investment, that is a provision that you see here that would benefit a company like that. I'm not, I mean, it's a difficult question to answer because you have a whole array of different types of corporations and businesses, all different operation styles and locations. So this is really kind of touching a huge swath of different company types, which makes the question a little bit difficult to answer in an easy way. Well, that's everything I have prepared for today.
Okay.
What is the timeline on that still?
They want it out by Friday because the money is figured in the budget. The budget is supposed to come out on Friday. And the budget can't come out until they know that we have voted out the money.
Budget's
That
strong.
$10 million.
Getting out of here on time.
Sounds like we can be gone by the end of April.
They spent the money that Chapter just showed you on the bottom line.
Madam Chair, would you like Chris to talk about the budget construct a little bit?
Sure, Chris from Joint Fiscal, my colleagues can give you all a spreadsheet if you want, but I think at the end of the day, the House passed a budget that relies on this revenue construct to essentially, being very colloquial now, but sort of pay for the $10 million that then goes to the transportation fund. And that then frees up some money elsewhere in the budget that has to be spent. But to Senator Hardy's question, what is sort of convenient or inconvenient, depending on your perspective this session, is that the tax policy in the miscellaneous tax bill is really the linchpin that holds the T-bill, the budget, and the yield bill together, because there is policy in there that affects all three major funds. So it is difficult to sort of solve the other bills without getting clarity on what the revenue policy is.
This also has the change of purchase and use and the percentage
Precisely,
fruits and meals, so that
yes.
transportation has an additional 10 million this year and ongoing. It's not,
And that is something that this committee is gonna have to sort out in order to finalize the T-bill also, because there are differences of opinion between those two committees.
Yeah. And also, we usually have uniform this tax bill at least to do other things with that, you know, as a vehicle for other things that we won't have.
I have expressed concern. Usually this is the last bill to go.
Yeah.
But, well, it's the next to the last. The budget is usually the last bill to go. When the budget's done, that's what we do with the floor and then we go home. There's been a difference in timing in the last few years, mostly because there's other things that might prevent both of these bills from getting through. And so the budget is going early, which means the tax bill is going early. I do not have another tax bill up there. I have expressed this concern to the powers that be. But I'm not sure what to do about it. I don't know. There may be another bill with the word tax on it coming over. Or coming to us from another committee. But
I always had the impression, I'm fine with doing miscellaneous tax up for all these reasons, but I always had the impression that finance had a lot of leeway in interpreting, and that's why we had that robocalls bill and then the feminine hygiene bill. We can do whatever we want with any of these bills. Is that not the
the word
case?
tax makes things germane.
Yeah, there's no.
Yeah, if it has a tax in it, then almost anything,
None of those H bills have a tax.
none of those bills that I saw have tax in the title.
Has to be in the title.
Yeah,
Well, I mean, it has to be in.
Tax or
Has to be
fee.
in
but
a mention of statute that.
that is the one concern with doing this. On the other hand,
As long as the Senate's okay, we can get through germaneness and stuff what we wanted. Trying to get creative here.
yeah, if no one challenges the germaneness, we're good to go.
Would you,
It's a challenge.
sorry to interrupt, Kirby King, legislative council, would you like to spend a moment? I'm supposed to come in on Thursday with, like, on miscellaneous tax. Are there things that, I have some technical things I'd like to go over with you,
Okay.
but I don't have any other requests directly from the committee about things you would like to see at that time. So if you'd like to, if you know of anything that you would likely want to see language on Thursday, I'm taking requests.
A lot of this is,
What's up to me?
tax department housekeeping. Changing dates from April to January. Records kept relating to deeds and mortgage, scholarship granting organizations. This basically says this is that federal tax credit. We had a proposal. The 1,700 you could take on federal taxes. We have to opt in or opt out. This basically says we're out for this year, but we can change our mind next year. The reason we didn't do it was because the rules hadn't been set yet, and there was kind of concern about what they might say about how much leeway we had. And this would kick the can down the road till next year.
I have a question for, I think, Chris, and then maybe some requests for. You mentioned a spreadsheet, that ties the, I think, 4 bills together.
Well, no, it's just those two about what we talked about on that sheet.
Oh, it's just a chart.
How that feed,
Yeah,
how
it's
that
not a
feeds.
spreadsheet.
No, it's online.
Table.
Tomato. What we have is I could show you on one of the appropriation spreadsheet where the number comes in on the budget construct from this bill. But I sort of gave you the verbal explanation that it's because this sort of pays for that $10 million that gets into the T fund that then frees up like $9
Okay,
million.
and the yield bill also takes into consideration the changes in the miscellaneous
But-
tax bill?
Yes, what you need to resolve is like, what is the flow of the non-property tax revenue heading into the end fund in order to calculate the yields? And you also need to have sort of a decision made on whether money is coming in or out of the ed fund as part of that comps you're
And how
So
does
if you
it,
go in a different direction, then the yield bill needs to get redone.
okay, and then there's the major education bill that's coming over that has quite a bit of
And that is,
finance stuff in it. I mean, it's in the future, but is there, that bill is not part of the equation of this table slash.
I don't think of that bill as one of the threads in the knot in my mind. I sort of think about the money bills and how they're all intersected, and it's because of that shift of the meals and rooms and the purchase and use. And what direction you all decide to go on this will influence what goes on with the yield bill, the T-bill, the budget and this.
Okay. One thing I asked Kirby and Patrick separately about was the renter credit and the, what is it called? The municipal, it's not a credit, but it's a,
The municipal, 45,000.
yeah, what is it called? Circuit breaker.
Yes.
And in the two of them, the renter's credit, I'm wondering when the last time that was changed, because I think it's quite low. And also when was the last time the circuit breaker was changed? 'Cause-
Yeah, this is John Grazer, and from what I recall, just working in taxes for a while in the state. It was 5 or 6 years ago that the renter credit was revisited. Now, I don't recall whether the amounts were changed.
That on averages,
I tried to look it up in the statute and it was really confusing. So did you have my email?
I did, I
Yeah.
had a chance to.
Yeah, no,
I'm sorry.
Super, no, it's okay. Okay, largely because that is an issue, you know, as rents have increased substantially in the state and the renter credit has stayed essentially the same. We didn't look at this in our conversation last year, but I heard from a constituent who recently moved to Vermont from another state that has a renter credit, and they told me their rent was significantly lower in the other state. And the renter credit that they got was higher, so they moved to Vermont and their rent is higher and the renter credit is lower, so that is making it much more expensive for renters, so I wondered if we could take a look at that. That might be in the context of the yield bill more because it's on property,
It's a general fund.
It's a general.
but it's, okay, it's a general fund, so that's
It's a general fund, but it's connected with.
okay. And then the circuit breaker, you know, we talked about the increasing municipal taxes and I know there's a lot of conversations about the pilot funds and how those all work and everything, but I don't think that the circuit breaker has been changed in a long time either. So as municipal taxes have gone up, we haven't done it there.
I tried several years ago. What it will do is it will increase your local revenue because it caps what, so.
Isn't there a general fund offset? So it's a general fund
It's all
thing. So
general.
I mean, I'm not saying, I wanted to know a
Yeah.
little bit more about these in the context of, you know, of quote unquote affordability issues. Like these are
Right.
both impacting people as their education and municipal property taxes are going up.
Tell me, I live in Montpelier. But we are the third highest in the state. We're back to where we were pre-Act 60. I think those are all good things. I'd like to look at them. Unfortunately, they're all going to impact the general fund, which is pretty
Well,
much.
it sounds like all of this is potentially impacting the general
But I
fund.
just figured. Again, the House has all day, they did it in concert with the budget. Once we realized that we were going to lose the 13 million and it had been figured in, I think there hadn't been adjusted for a budget adjustment. I think the governor used it because it hadn't been deducted in the July forecast. So it was in the budget and they had to take X million out or find a way to put.
No, I understand how we got here. I just
Yeah,
don't want us to be forced into just concurring when we might have other things. And then there were some tax issues that we talked about earlier this session that I assumed we would get back to when we talked about the miscellaneous tax bill.
I had two or not, but that was before this construct, or I knew about it. This is not your usual miscellaneous tax bill. But it's not your usual times either. And normally this would be going out May 10th if we were going home May 15th, or later. But
I do know, I think believe that means they are going to be voted soon on the tax bill. The high earner, wealth tax, I don't know the details, but
there's a study in
I can help you with that.
this one, or
There's Ways and Means tomorrow. I'll be going through a potential committee bill with them. Relating to the Vermont investment proceeds tax concept, the wealth proceeds. We went through that in here. Because it was part of S-282 also. And also part of that is creating a new personal income tax bracket, a new higher marginal rate of 3.3% or 13.3% on incomes over 560-ish thousand, which is for married jointly. So those are the two things they're looking at that came out of some compromise over some floor amendments on miscellaneous tax.
okay,
No idea at this late stage of the session what that is, other than to look at it.
it's a committee draft.
It's a committee draft. So they're gonna look at it, is all I can say.
because when the 10-year tax study came over, my understanding was that was what they were doing because they couldn't get the votes to raise any income
I
taxes.
think the 10-year tax study is a standard thing. that
It
happens.
is, but it looks at how we line up with other states regionally, nationally, so it gives us some helpful information. I just saved, and I don't know if I could save it, one recent study where Vermont had the third highest tax bracket, tax burden in the country. Only behind California and New York. And if I can figure a way to send that to everyone, I will. But I think that's what they were trying to get. And I don't know. We can work on it once we get the time.
Work on what?
Well, I'm concerned that our high tax bracket, which is one of the highest in the country, starts at 300,000 for.
Oh, well, isn't that kind of what they're looking at?
That's
in
what
the
they're
House,
looking at.
is changing that.
Because, yeah, when we responded to the Tax Cut and Jobs Act, we took out we did that when we did the Blue Ribbon tax study. We took out the fifth bracket because it was extremely high in the country at that time, and the thought was it was keeping us from being competitive. And we combined them. But it's now, since incomes and costs have gone up, 300,000 is comfortable, but not extremely wealthy. And it breaks in a lot of professionals that we need in order to set up and grow businesses, or doctors and nurses, any kind of coupling financially. It's hitting professionals, especially when no income tax. New Hampshire is next door, and so
It's a millionaire tax that starts at 325,000.
Yeah.
Can I ask Chris maybe another question? So looking at this table,
The fiscal note.
yeah, the net fiscal impact of the bill down at the bottom, the
Yeah.
3.08 and 2.07 in general fund, that is included in the big bill.
Yeah,
They use that revenue.
that's all reflected, yeah.
Okay, and the education fund is used in the yield bill. And then the T bill is the one where our transportation committee and this have differences of opinion.
Correct. So the House's version of all these bills lines up to what's in the House miscellaneous tax bill. So, Senate obviously is not the House, so that's why like your decisions all sort of intersect with the same.
Yeah. Okay,
If you're asking if there's extra money on the bottom line, regrettably, there's not.
yeah, well, I figured there wasn't, but it's always good to ask.
I don't know what will end up in transportation. I know the chair would like a version of the governor's take 10 million, take basically the purchase and use, which is primarily automobiles. Take it out of the education fund at the rate of $10 million a year. And I think they'd get a 10 million from the general fund this year, so it wouldn't impact. But by next year, we'd be up to 20 million out of the ed fund. And after 5 years, we'd be up to $50 million hole in the ed fund. I see no foreseeable way of filling that hole right now. I'm very concerned about, with all the changes going on in education, trying to do something that drastic. So the proposal here is we change the percentages. It's the $10 million loss to the general fund, which is being made up by this decoupling that's in this bill, which allows transportation to get $10 million additional of purchase and use tax. It's on automobiles, so there's a logic to it. And that's ongoing money. And it doesn't take $50 million away from education over the next 4 to 5 years.
I think the counter argument perhaps is though that it takes more money out of taxpayers' pockets. It's just a question of which pocket.
Well, the money is being raised in decoupling it, so it's corporate. Probably not Vermont-based corporate.
Well, that would be one thing
Yeah.
to really know. What's the effect of that on quote the average Vermonter, if there is such a thing? What's the effect on Vermont's ability to compete and to do business and to live?
You're gonna compete right here. So you could just decide not to sell it if you don't want it.
Madam Chair, I did have posted on the committee page under today's date, under my name, there is a very short slide deck that compares the governor's construct with the purchase and use tax to what is in the House's. Well, what's in the miscellaneous tax bill and what came out of the House. I can update that once something comes out of Senate Transportation this week to reflect what they do. But my understanding is they're leaning in a direction based on what I've seen in committee that is closer to where the governor's proposal was rather than the House's proposal. But in all of these constructs, in FY 27, the ed fund doesn't lose $10 million. It's just a matter of like what happens in the out years. And it's a matter of what this committee and the Senate agrees to do. So that's why this is sort of an open decision point that needs to get resolved so the yield can get resolved.
And I'm gonna move us on because John and Julie.
Can I ask a quick question?
Yes.
I don't want to keep those guys for sure. We talked about the qualified small business talk earlier. We talked about what ads, one thing Pat went over.
Okay.
And we talked about how there's the House Floor amendment that I need to fix my own.
Yeah.
policy. Would
Bring
you,
that to us.
would you like me to bring you something on Thursday that
Yeah.
would be closer to the House's intent?
Yeah.
Is that the, okay.
That would be helpful. It's Okay, so we're going to John and Julia. I don't know who's coming first, but we have this on for possible vote, so you all better do a really good job.
John's it raining out?
No,
It's been
don't know what you're talking about.
there are, I think, 2 or 3 umbrellas that have been in that closet for at least 10 years.
It's good to know that I didn't use something that was available.
If anyone needs an umbrella, I have a brand new big great umbrella, but it's in the truck of my car.
Yeah, immediately large umbrella. So it covers 10 people. Gotta clean the bathrooms. Get a homework, mine. It's on the wall right there. Oh. You can lift it off your shoulders. Yeah.
Okay, so we're gonna start losing people shortly, so let's move this.
Let's do it. Okay,
Let's do it.
so I am still John Gray with the Office of Legislative Counsel, and we're looking at the yield bill, which is very exciting.
We've had a very exciting afternoon.
Oh, yeah? I've seen flickers of some of the things that have come. And I'll leave it at that. Okay. Here's the yield bill.
Mocking us.
I would
This is a
never,
nice, clean bill, right? We're not
yes.
good.
Okay. So yield bill, you know, the sorts of things that are typically included in this. There are some technical changes for cleanup and finance measures that I'll come to. But the first 2 sections speak to the approach to FY27 tax. And so, just to foreshadow what you're going to see later, half of the 104.9 million available from the general fund transfer is being applied as proposed here, which results in a property owner equivalent yield of 9,170, income yield of 12,576, and a non-homestead rate of 1.698. The remainder of that balance, which is 52.45 million, is reserved in the ed fund to offset tax rate increases in FY28. You guys are familiar with this language. I don't think I have to belabor it, but the Commissioner of Taxes is number 1 letter needs to make some assumptions in setting the yields, and this is directing the Commissioner to make these assumptions related to the reserved 52.45 million, so that next year's recommendation reflects that 52.45. And I will let Julia explain the fun things about what it actually means. So jumping past the traditional yield pieces, we have some cleanup changes. The first of these is section 3. This is amending the chapter that covers the property tax credit. And this is cleanup for the statewide adjustment. Do you guys need orientation on the statewide adjustment, or can I just say that what this is trying to do?
Say what it's trying.
Okay. So basically, in the absence of this, what this proposal does is, when the statewide adjustment was introduced, it was meant to be mathematically neutral, right? It's just meant to affect the presentation of property tax bills so that the amount of variation you attribute to the CLA is reduced. Basically, the statewide adjustment is supposed to reduce that attributable variation.
Yes.
And so changes were made throughout the education property tax chapter to offset, to produce that mathematical neutrality in the denominator and numerator. But in the property tax credit chapter, one of the things that hadn't been addressed is the relationship between the income yield and the property yield. So this, in the absence of this, the calculation of property tax credits was thrown off. You had changes on the property side of the equation, but not on the income side of the equation. And so what this does is it just insulates that chapter from this essentially, and it results in the calculation you would have pre introduction of the statewide adjustment, and it doesn't have any effect on the presentation of tax bills either. So this doesn't undo anything the statewide adjustment is meant to do. It just insulates the chapter so that the calculations align and your property tax credits come out correctly. That is the
Okay. Feels like a leap of faith, but
sure.
Julie says that's what
Julia
it
says.
does. Julie says that's what it does.
I also say that's what
And you say, and she crunches the numbers.
Sure, sure. That's good. I like that. Okay, on page 3, you guys will be familiar with these provisions. You've even seen one exactly like this for the city of Berry recently. It might have been last year for the overpayment in FY 16 through 20. I think that's attributable to a software issue, is my understanding, that has now been resolved. At least that's the claim. So this is hopefully the last refund from the Ed Fund for $150,576. It's appropriated from the Ed Fund to the Department of Taxes in FY 27 for payment to the city of Berry to compensate for those overpayments in FYs 21 through 24. Section 5, this looks way more complicated than it is. Your census block grants. This is in Title 16. When the statute that was created that provided for these, it provided, as you'll see in struck through language on page 4, all these fun mathematical adventures, including different inflationary factors depending on the year. And it made for this very messy statute. And the main thing that was omitted here, the reason that this provision originated, is that it provides for inflation through FY 26, right? You can see that here. It provided for no inflation FY 27 onward. And so this is a provision that's included to inflate that census block grant moving forward, as you might have expected. I think it was just kind of like an oversight in what was done at that time. And it also cleans up the statute so you don't have all these transitionary measures in there. So it ends up being that the uniform base amount means 2350 as adjusted for inflation. I do want to call out the unique inflator that is included here. Typically, you guys have seen just the annual change in NIPA. What's proposed here, I think, to reduce variation, volatility, would be a 3-year rolling average effectively. And you can see that on lines 16 to the bottom of the page, adjusted for inflation each fiscal year beginning in FY 28, because this figure reflects the FY 27 figure. It codifies that FY 27 figure and adjusted by the most recent 3-year average annual percentage change.
Oh, so 3-year average of NIPA
Yes. And the annual change, it's not taking a 3-year total. Yeah.
of the average change, yeah.
What would that mean if you have a year where you have an unusually high number?
Right. So that's exactly what this is intended to address for, is that you have it counteracted by the other 2 years included in that period. You could imagine that
Yeah,
if you just use the standard annual change provision, you can have some meaningful fluctuation in that year in which you have a high change.
Is NEPA the one that went away?
What's
what's going on?
Neat. England economic.
Okay, NIPA is in, is out.
All right, cool.
All right.
We're gonna create some new ones.
I thought it went the other way too, but.
And just to, so what this does just explains some of the context. You've heard the core thing that this provision is trying to do, but the uniform base amount is a per pupil amount effectively that is multiplied by your student counts to produce the census block grant, which is an aggregate figure. And so this sets your effectively per pupil amount. And then you can see in statute the way that it works. The state commits to satisfying its special education maintenance and fiscal support efforts requirements. Spells out the process for receiving a census grant, use that funding to provide special education services in accordance with IEPs as mandated under federal law. And then you see the cleanup of transitionary measures that we no longer need. And the very simple calculation, the amount of the census grant for a supervisory union shall be the uniform base amount at 2350 as adjusted for inflation multiplied by the supervisory union's long-term membership. Much easier to read this section now. And that is the main thing I care about.
I love that too, John.
And then
Through the transition, all of that was language that spelled out transition, been through it, so.
For a law that was passed almost a decade ago now.
Okay.
and it's effective July 1, 2026.
and the only number that is the 3-year average is the number of the amount that is spent. It's not student population.
The 3-year average is just for the NIPA annual change. So the effect that what that plays into is the uniform base amount, that 2350 per pupil. Exactly. And that is it. That is the yield bill.
Okay. Any questions for John? I've told upstairs we're not gonna vote anything out tonight. I'm starting to lose people and I'd like to let everything settle. But tomorrow I'm gonna try and vote this out. 710, that utility, the driveway.
Someone reminded me that there was a PUC wanted an amendment to that bill. They had a little technical change they requested in their testimony. Somebody just reminded me when I was out in the hall going back and forth.
Well, they
So-
need to get it to us.
I think
She
they
emailed it to
about an hour ago.
about an hour ago.
Yeah, so, yeah, they told me to tell you because you wouldn't be looking at your email. So I was waiting for you to bring up the
Okay.
bill.
So I would be looking to amend if this is truly technical. And vote both of those out like first thing or last thing, probably first thing tomorrow.
Are we gonna hear from Julia to go over that?
We are going to hear from Julia, yes. I was just giving all things, okay. So Julia, come on up. This is probably the simplest bill we had this year. Great. I mean, actually, the yield bill in former years has been attached to miscellaneous tax. Last year, it was a major bill and came over like the last week of the session with a lot of the educational changes on it. This year, it's pretty simple, but probably should go alone since miscellaneous tax is not pretty simple. So we'll see if we can get this out.
All right. Julie Richter, Joint Fiscal Office. I'm gonna go ahead and share my screen. There are a few documents in the committee page under my name. There's the fiscal note. There is an Ed Fund Outlook I put together for the committee. And then there's also an issue brief JFO published one of these days. An issue brief on what happens if there's no budget and another issue brief of what happens if there's no yield bill. So if there's no yield bill, that issue brief is also posted on the committee page under my name. Madam Chair, do you want me to start with the fiscal note?
Sure.
Okay. So John just walked through all of this, so I think we can go through it pretty quickly, unless you want to at least go, we can go through sections 3 through 5 pretty quickly. Section 1, this is setting those yields and rates. The house construct uses half of the 104.9 general fund one-time transfer to uniformly lower tax bills in fiscal year
That's why
27.
this one may not be going out tonight, because that is the subject of some discussion.
Yes.
Okay.
So, so the house construct landed on, there's that 104.9 million in the general fund being transferred in the big bill. Assuming that your Senate Appropriations Committee keeps it, being transferred to the education fund for lowering property taxes. The house construct uses half of that one-time money in FY 27 to uniformly lower bills, and then reserves the other half in section 2 to use for lowering bills in FY 28. So this 52.45 million that's reserved in FY 28 is just half of the 104.9 million. The House Ways and or House passed version of the yield bill. When they passed the bill, that represented an average increase of 7% for all property tax bills as compared to the prior year. That's the estimate. When we get to the outlook, that's the average. So when we get to the outlook, as always happens or usually happens, we have updated budget data. So that's not the uniform increase anymore. So if you were to want to keep the house construct and make no changes, there would still need to be an amendment from this committee to align the yields and rates with the updated budget information.
Okay.
But we can talk through that when we get to the outlook. So Section 3, this is that technical correction for statewide adjustment, JFO, Ledge Council, Tax Department, all worked on it in consensus. We all agree it needs to happen so that the statewide adjustment doesn't have a fiscal impact. Section 4, this is the second half of the Barry TIF overpayment that needs to be refunded back to the city of Barry. This comes from the Ed Fund because it would be 150,576 de minimis impact to the Ed Fund. And lastly, Section 5, John just did a great job walking through this. Essentially, it's codified the census block grant for special education uniform base amount in statute at $23.50 for FY 27, and then increased by inflation each year. This is what AOE has already communicated to the field. It was included in the GovRec budget and then included in the House budget for the purpose of calculating the special education census block grant. So there's no fiscal impact because this is essentially lining up statute to what everyone was anticipating.
This is the first year it's uniform in FY.
Correct.
Correct.
Yeah.
Okay.
Which is why now we could put a uniform
Yeah, we
base
could
amount.
do this.
We can put just like a number in statute to make like.
Okay.
And based on conversation, we had some good conversations with AOE, based on conversations with the AOE, this is the number that had they've been going towards, yeah. From Act 73. Not one, Act 173. Thank you. I've been doing a lot of Act 73 today.
Yeah.
Excuse me.
Get me on.
So I'm just gonna reel my hand a little bit and what I said on the radio, and I want to pose it as a question to Julia, but what I don't support this bill as it currently is. What I do support is using that full 52,450,000 to buy down the tax rate this year. And I'd also like to add the S220 language to this bill, but do you have the mock-up of what the full buy down would translate to?
I had a feeling the committee was gonna wanna understand that.
Great.
So moving to the outlook, I'll just walk through what we have here. So reorienting ourselves, and a reminder, we're now using budget data as of March 16th. So this is an update from the budget data that House Ways and Means and the House was looking at. FY 26, this is that preliminary BAA, nothing's really changed there from the last time I was in here. Column V, this is the House pass construct, which I know this isn't the question, Senator Chittenden, but lining us up. Column V, this is the House pass construct to use half of the 105 million to uniformly lower property taxes. This is what I want to call out, where if you, I'm not saying that you do want to, but if you were to want to keep the House construct with the updated budget information, things flexed. And so because school budgets came down further between the February update that we're looking at and the March updates by around about $5 million, now it would be a uniform average bill change of 6.7% if we were to move to the non-homestead yields. You see that one-time general fund transfer being assumed here in line 8. And then you see half of it being reserved here, or that's the transfer, and then half of it being reserved here in line 35. I do want to also note that this construct uses a 22.3 million of Ed Fund surplus to also uniformly lower property taxes in FY 27.
Yeah.
So the House construct is using a 52.5 from general fund plus the 22.3 of Ed Fund surplus to uniformly lower.
Uniformly lower. Did you ever look at not uniformly?
Yeah, and I can certainly come back. The process in House Ways and Means, as some of your colleagues are intimately aware from their time prior in the House, is usually starting in like the second week of the session. I go into House Ways and Means every week and they look at it, outlooks, and they did explore what happens if the buy down is used only to certain classes, or shaking things up, adjusting the property tax credit, and we can certainly do that here too. Great, yeah. That's column B, that's what the House passed. Column C, this is, I wanted to sort of show like the two extremes, so to speak, of the box that we're working in. So sections, column C is what if there was no general fund transfer to the education fund. And there was a uniform bill change. So if there was no money coming in from the general fund, that would result in an average uniform bill increase of 9.9%, so 10% compared to the prior year.
That does include the 22 from.
It does include the education fund surplus, yes.
Had the impression that when the ed spending from the December 1 letter was then marked down with updated numbers from a few weeks ago, I thought that was at 4.3%. I thought I just heard you say that it's been further marked down, but I'm still only seeing 4.2%. Am I not remembering correctly?
You are remembering correctly. So you're referring to line H. So the difference is, and this is a little bit weedy, but the estimate is still 4.2%. The 4.2% was as school budget information came in, that was the estimate. However, we didn't have a number of school budgets, so we weren't including them in the average. We had to use the 4.2% to project what their education spending would be. But now that we have the updated budget information, it's still 4.2%.
Okay.
Because really compared in the context of an education payment of $2 billion coming down by $5 million seems like a lot. And in terms of percentage points that where it's rounded, it's not making a significant difference.
Why did the House estimate go from 7% down to 6.4%? I thought I heard you say that 6.4% is an update from what had been said at
Yes.
the House. Why did it go down?
Because of updates to education spending. But what I'm saying is that because if you think about the way that the education fund works and the scale of the numbers that we're working within, a decrease will significantly impact certain tax rates, which would correspond with a more significant impact in uniform average bill change, because that's weighting the tax rates by district size. Whereas when looking at the ed fund as a whole, it takes a lot to move the needle to where it's not rounding to the same, or it takes more, I guess I should say.
Last one. So if the committee is amenable to adding our S220 language to this bill, would you expect that S220 estimates to also have fluctuated since you last ran those numbers based on that same?
S2.
That's the excess spending threshold penalty bill that we had.
Okay.
Lowering it too.
So
Do you understand my question? It's like, are those numbers also adjusted?
they would be.
That assumes that passes the House.
And I guess I would say that
Well, what I'm posing on, Sharon, you mentioned this on the radio, and I think I mentioned to you as well, WVMT. So just.
It was a good segment. You should have given it a listen.
Yeah, I think what the House did is sensible. I do think splitting it up into two, I think equally sensible is to give property taxpayers the relief they need with the full buy down, coupling it with what I see as sensible policy, which is lowering the excess spending threshold. So what I said is I support the full buy down coupled with what we did with S220. That's just what I said on the radio where I currently am on this bill. I also qualified it by saying that's where I currently am, and I'm looking to understand more about the give and take of these topics.
I appreciate your sharing your opinion. I don't agree with it, but I appreciate sharing.
Okay.
I would, I just want to clarify one thing about the S220 estimates, that the S220 estimates that the Senate looked at and this committee looked at when you're considering S220, those would be refined with the new budget data. However, assuming that the S220 construct as passed out of the Senate were to be included in the yield bill, because that's not effective for FY27 and it'll be effective for FY28, we wouldn't see any estimated impact in this outlook.
Makes sense.
Okay.
Okay, so that's column C. If there's no general fund monies used to buy down property taxes, but there is the education fund surplus. And lastly, on this ed fund outlook, but there of course are infinite different ways to do this. Column D is if the entire 104.9 million of one-time general fund were to be used to uniformly lower property tax bills in FY 27. So answering your original question. This would be in addition to the 22 million ed fund surplus. And if it were to be solved uniformly, that would result in an average property tax increase compared to the prior year of 3.6%. You can see that general fund money coming in here in line 8. And then that entirety of it being used in lines 29, 37, and 35.
Okay. Any questions at this point? I think we probably have enough numbers. I'm not, the one point of contention here, since it's policy, these are numbers, the yield is set on numbers, is what do we do with this general fund transfer? Or it's from last year. I assume that the budget is holding that. So the question is, do we put it over 2 years? I know originally the talk was 3, which is when the foundation formula goes in. The concern is that if we buy it down all this year, the sticker shock, it's like utility bills. You keep buying it down, and then the full bill hits you in next year. It is extremely painful to people. And then when we go to a foundation formula, that is going to be extremely painful to some schools. And we haven't figured, I believe there is work in the education bill that, did they vote it out on Friday?
Yeah, so the H955 was voted out of House Appropriations this afternoon.
So we will get that maybe early next week, depending on how long it takes to get it off the floor. And I believe that has transition ways to transition high spending schools down and low spending schools up, and the relevant, because tax rates will have to be adjusted. And we'll work on it. But there's a lot of adjustments coming that, and so that I think is the big one. Other than that, it's some housekeeping, and the yield is a numbers calculations.
Well, I just wonder where the administration is on this, and whether or not you're gonna have a potential veto.
So I think the governor has said he doesn't like this plan.
Chris, the yield bill uses general fund to buy the tax rate down. And did anyone look at using that general fund surplus to just help the T fund instead of moving funding sources around in this somewhat
So
confusing way?
the governor's recommendation actually had that transfer at 114.9 million, 10 million higher than that number, and 10 million of that would have essentially paid for in the ed fund the cost of shifting 10 million of purchase and use tax out of the ed fund and into the T fund. So in that sort of I think of that like recycling symbol with the arrows and the triangle, like. In that construct, there was still $104.9 million going from the general fund into the ed fund to buy down rates.
Mhm.
So that I have not seen any different construct with that relative to transportation. What Senate Transportation has been talking about is why have the ed fund be the middleman for that 10 million? Why not just send a $10 million transfer directly from the general fund to the T fund and keep that transfer going to the ed fund at 104.9? At the end of the day, like, it's a different path to get roughly $10 million from the general fund into the T fund. The impacts from all of these policy decisions that are outstanding are really FY 28 and beyond. And whether the impact of that falls on property taxes, on education property taxes, or whether that falls on the general fund or some other yet to be determined transportation revenue.
And I guess I would say to Chris's final point of that impact showing up in FY 28. You know that ed fund has a portion of purchase and use tax, so that 10 million would be one time in FY 27 to fill the hole in FY 27, but come FY 28. If there were to be a phase down of that purchase and use tax, Chris's point, that would be picked up at property taxes.
Right, so if we're buying down the rate even more and we're allowing the purchase use tax thing, then we're just creating a bigger hole that we're gonna have to buy down in the future. And that's what we did last year. We created this big hole that we're now talking about buying down again this year. And so it seems to me if we have this one-time general fund money, we should, instead of creating bigger holes in the ed fund, maybe we use it to buy down or, help the T fund and not create a future hole in the education fund and do it even big, make it an even bigger hole than it already is. I mean, one of the reasons the rate is so much higher this year is because we bought things down last year. We created this problem for ourselves. And in fact, members of this committee argue to create this problem for ourselves. So it's strange that we're doing it again. Wait.
I'm sorry, I'm in a committee, I can't think of call. Yes. Yes.
Yeah, and like, Madam Chair, I gotta just follow up on Senator Hardy's comment.
All right.
Doing policy decisions, you all land on the T fund. If you were to do a $10 million transfer straight from the general fund to the T fund, that still creates a hole in the T fund in years beyond that. And I just want to give the committee some context that $10 million leverages over $60 million worth of project investment because of the federal match at play. So that is an important consideration of like not creating cliffs in any of the major funds. And one thing that the House's construct did that's in miscellaneous tax is it doesn't create a $10 million cliff in FY 28. It shifts $10 million on an ongoing basis, give or take a couple $100,000 with revenue growth. But it doesn't commit to doing, step 2, step 3, step 4, and step 5 to get you all the way to $50 million for the T fund. It takes step 1 and stands on step 1 until the legislature agrees to go up another step. It's a nuance, but it's an important nuance because I've heard this described inaccurately in the building. So I just want to be really clear that construct was not just a one and done in FY 27.
Okay, so it does fill the hole in the education fund.
Yes.
But what the governor
For 10 million, yeah.
for the 10 million,
Yeah.
but what the governor proposed would not have filled the hole.
Correct.
Okay.
It only would have filled the hole in FY 27.
Right,
And,
okay.
and then that hole would be filled on education property taxes in future years, absent the legislature, making a policy change or doing something else. But when all else is equal, that hole would get filled by property taxes on it.
Right, so that would increase, the governor's proposal would have, all things being equal, increased property taxes in the future.
Correct.
Yes.
That's a fair statement.
About
Assuming
$12 a penny, so
the Meals on the Rooms doesn't go up. and cover that.
figure out
Like it is
50
there.
million out.
Right.
And that was not the governor's construct. So the governor's construct had that pulling out of PNU over the years, backfilling it in FY 27, and then that was it. And then the House changed it to backfill it with the ongoing meals.
So it's ongoing and the education fund is how transportation gets 10 million, provided the taxes keep coming in, the economy that department. Roughly an equal transfer, and that's ongoing, so they don't have to rely on getting 10 million plus. Yeah, miscellaneous tax, the decoupling raises that $10 million so that the general fund is also held harmless.
The yield bill in section 2 with the ed fund reserve, the 52,450. The yield, the House version uses 27, uses half of it in 27 and then reserves the other half for use in 28.
That's correct.
Yeah.
And this would assume the entirety of the 105 were to be transferred from the general fund to the ed fund, so it wouldn't fall into the big bill contingencies. So it would all be transferred to the ed fund, and then half of it would be put in reserve.
Which is, okay, kind of what I proposed last year in here was the reserves and funding so that we could use it this year so that we wouldn't have this big percentage increase that we have.
I think this is about all we can pursue for today. Thank you, everyone who's held with us. We are now